I'm the Director of Research. That job basically means what I do is coordinate research activity for Colliers in the U.S., manage all of our different projects that we've got going on. I work with all of our researchers in our different offices all over the U.S. I am not our chief economist. That's Ross Moore. Ross is the real expert. I consider myself a student, but I like to think of myself as a student and a teacher too. So whenever I learn about new things, I turn around and try to make them into a Colliers University class. So that's kind of how I got to creating a class on real estate value cycles. So you should see an image on your screen of one cycle that's not exactly scientific. This is an email. I can't take credit for this. This is an email that's been forwarded around a couple of times now over the years. Brokers always like to say that, at least in the U.S., that there's a 10-year cycle to commercial real estate, and sometimes that's been true. But at any rate, this is not a scientific cycle by any means. You know, we're starting at, optimism, and as things get better, you get, really thrilled. But then at some point, your thrill and excitement turns to greed. Everybody's making money, and all of a sudden, that greed causes, things start to turn down. And at first, you're still hopeful, and then you're in denial. It turns to fear and then panic. And where we're at right now in the U.S., boy, I'd like to say that we're beyond the foreclosures and the depression, and that we're some point into the relief. But that really, I think, to a certain extent, depends on what market you're in. So that's kind of a silly emotional market cycle tool. But what I want to look at is a cycle tool that we actually use at Colliers. So what this is, and this is something, I'm not sure where this developed originally. We've kind of based ours on something that came out of PricewaterhouseCoopers. We've taken every market in the U.S. and we've tagged it with where it is in the cycle. And we've actually got 12 different stages of the cycle. But you can actually break those down into 4 stages: recession, recovery, expansion, and contraction. So what I thought we'd do might be interesting to start out. You should see a poll up on your screen. How would you label the state of your city, your metropolitan area, or your country, if you like? How would you rate yourselves in the CRE market? So are you in recession, recovery, contraction, or expansion? So I've got 3 people who have answered. I want to wait and have a few more people to answer this one, because I think this is an interesting question. And what I can say is that cycle, though it looks neat and clear on your screen, whereas it's everything's evenly paced. One stage from recession to recovery is evenly paced as from recovery to contraction. In real life, that's not really true. You might quickly jump to contraction while it may take a long time to get to the next stage in the cycle. So let's take a look at what our poll results are here. Let me click to unhide our poll results. So we have 4 respondents today. Thanks for responding, and 3 of you feel like we're in recovery, and 1 of us feels like we're in expansion. So if I could, does maybe perhaps somebody who's answered that their market is in recovery, could one of you pipe up?
This is Doug. We are in I tentatively said recovery just because it's not receding, so it feels flat, but definitely not expanding.
Well, that's good. Doug, now you're talking specifically about Northern California?
Primarily, yes.
Yeah. Okay, great. Well, what's good about this is I've been taking this poll every time I teach this class, and the responses are getting more positive every time I teach it. So that's good news. So from that, we can see that everybody on the phone, you've all got an idea of where you stand in the market cycle. Some people feel like you're expanding, some people feel like you're recovering, but you've all got some idea of where you stand in the cycle. But let's step back for a second. How do we know that market cycles even really exist? And that's sort of the question that caused me to create this class. And so here's some questions that I want to see if we can answer. And we'll go one by one through these. So do they really exist? Do market cycles really exist? If they do, what causes them? If they do, are they the same in every area? Our poll results would say they're a little bit different across different areas, but let's take a look at that closer. Are they the same across different product types? So do we see market cycles in retail real estate in the same way that we see in industrial real estate? And so if they do exist and we do know about them, how can we use market cycles? What's the value of knowing about market cycles? So the first question on the list, do they really exist? This is not my slide. I've borrowed, especially in this presentation, I've borrowed liberally from the MIT Center for Real Estate. These guys are definitely leaders of the pack as far as thought leadership in commercial real estate is concerned. And I visit their website at least monthly, sometimes more. Get a lot of information from these guys. So this is one of my favorite charts. So let's take a look at what we've got. This is a chart of valuation. And you've got the blue line and the red line. So the blue line, what the label says there is NPI appreciation. But to translate that into English, basically what that means is appraised values. So NPI appreciation is basically they'll go out and ask institutional property owners what they think their properties are worth. And all these institutional owners regularly have appraisals of their buildings. So we can look at that blue line as basically a proxy for appraised value. And the red line is a lot easier to understand. The red line is just transactions, so sales values. So actual sales versus appraised sales. So something else that's interesting, I'll stop for a second, is that this chart is from the first time I did this class in 2009. And what you can see on the upper right-hand side there is that we're really in free fall at this point. We've clicked and clacked up to the very top of that first big hill on the roller coaster, and we're just like halfway down and our stomachs have completely dropped. But that was a while ago. So let's update this chart and see where we're at now. Well, it looks like we've actually bottomed out, and they've labeled 2010 as the big bounce. So what I find interesting, if you remember that blue line is just appraised value, that blue line is a real smooth, down and then up again, whereas the real value, the prices that things actually sold at, they definitely bottomed and are on their way back up, but there's a lot of bounce. There's a lot of bounce on that. So what we see is a lot more volatility on prices, on actual prices, than you see in appraised value. So that's more of just an aside. What is really important here, the reason why we're looking at this chart, is we're asking ourselves, do market cycles exist? It doesn't look to me like market cycles exist when I first look at this chart. But, I think in my mind, well, I know that market cycles do exist. So how do we explain why we're not seeing these changes, this up and down and changes in values? And it's actually pretty simple, because here's the same chart. This is the same information, but it's adjusted for inflation. And now that's where we see the cycles. In fact, what I think is most amazing about this chart is the peak in 2007 does not really look that much higher than the peak was in 1984. So on the long-term view, when you adjust for inflation, we've got this very cyclic down and up again, and then down again, and probably up again and down again in values of commercial real estate. So from this point of view, on a transaction sales price level of commercial real estate, there's absolutely a cyclical nature to the value of commercial real estate. So we've answered our first question right off the bat. There's definitely a cyclical nature to sales values. So the next question, we know they exist. What causes the peaks and the valleys? And in the most simplistic term, it's a mismatch between supply and demand. And here's actually a nice chart of what that looks like. So believe it or not, you can actually chart supply and demand of commercial real estate. So the demand, the red line on this chart, is basically reservation price, or what they'll call private valuation. So a lot of people, the way they might understand reservation price is, let's say you're on eBay and you've got a Pez dispenser that you really want to buy on eBay, and you bid $5 for it, but then you type into eBay and you say, but I'd be willing to spend up to $20 for it. That $20 is your reservation price. So that's the highest price that you'd be willing to pay for the Darth Vader Pez dispenser. So that's the demand on this chart, the most that somebody would be willing to pay for a piece of commercial real estate. And then supply is just the opposite. What is the price that sellers are willing to sell? And when you get this crazy volatility is when the buyers and sellers are really out of whack. And you can especially see that, with the peak and the trough of our most recent up and down, you can see that there's just a big space between supply and demand. There's a big space between the prices that people are willing to buy at and the prices that people are willing to sell at. And that, in essence, is the cause of the cycle, that imbalance between supply and demand. But that leads me to another question. I know that cycles exist. I know sort of now I'm having an understanding about what causes them. But what I want to know now is, are they the same across all different types of real estate? Do different property types have different kinds of cycles? So here's the first one. This is the first property type. When you say the word real estate, this is what people think of. This is single-family residential. Single-family residential is pretty easy to understand. There's some pretty simple drivers to the value of single-family residential. I mean, you've got the supply, which is, construction, pace of construction, amount of construction. You've got vacant homes. You've got the demand, which comes from employment, availability of credit. And when you get a lack of equilibrium, that's what drives the cycle up and down. So if you've got too many houses and not enough buyers, it goes one way, vice versa, it goes the other. So when we're looking for a cycle in single-family residential, what we're looking at is this blue line, the home price index on this chart. Now this is classic. This is textbook. This is the most beautiful cycle you're ever going to see. This is just pure down, up. Absolutely. Single-family residential has the clinical definition of a market cycle to it. But that's single-family residential. So the next question is commercial real estate as simple as residential real estate? So we'll go through some property types and take a look. Now, right off the bat, you can see it looks a little bit more complicated. So this is industrial real estate. And again, let's look at the blue line, because that's going to be representing what the real rent is. Industrial rental rates are correlated with employment growth. We know that, but the difference is there's a real lag to it. So employment changes, and it takes a while for industrial to change. So for example, if you look in your chart in 1984, employment growth dropped, but the rental rates didn't drop until 1986. As an aside, I should probably mention the gray bars on these charts, the gray up and down bars represent recessions. So those are really important. And if, for example, in single-family residential, I should go back to that real quick. In single-family residential, you can see a real correlation between recession and value. Every time you see a gray bar, you see a drop in values. So there's a real strong tie between the economy, which is GDP in the case of the recession, and the value of residential real estate. But now we move into industrial, and it's not quite as simple. It's not exactly that tight, as a tight correlation. So let's take a look at office. If you thought industrial didn't correlate, office is totally crazy. Office values move to the beat of their own special drummer. So for example, again, the gray bars represent the recession. We got 4 recessions, but on this chart there's only 2 value cycles. So office space does have a cycle, but it doesn't seem to correlate with the economy, and it's a different kind of cycle than we saw in the other property types. So now let's look at retail. Retail, again, doesn't correlate with the recessions. You've got, in that recession of 1985, you've got values peaking, the recession goes away, and suddenly values start to drop. From 2001 to 2003, the rents are going up while employment growth is staying at 0. So retail doesn't seem to correlate with the cycles of the other property types. In fact, different property types seem to have their own different cycles. So now we're answering the next question. Cycles occur differently across different property types. So that begs the question, why? Why do cycles occur differently across different property types? So here's all the past 4 charts that we've looked at. We've got 4 different market cycles. And again, let's just look at those blue lines on each chart. Each one specifically seems to have a cycle, but it seems to be different. Moving from your textbook single-family market in the upper left-hand corner to the office in the lower right, which has got its own kind of thing going on that we're not even sure where that's coming from. So MIT, my favorite guy at MIT is William Wheaton. What he's said is that some property types only react to outside economic forces. And that one of those property types, for example, is your single-family residential. It's just, the market is just a reaction to the economy. But then you get these other property types, like office, for example, that would be cycling up and down even if employment and GDP remain stable. So office space, even our office values, even if we had 3% annual growth in GDP from here to eternity, you would still see cycles in office space because of how office works. So let's move on and see a little bit more about why some property types trend well with the economy and others don't. The less elastic the supply, the more cyclic a product type will be. So what does that mean? What is elastic versus inelastic? Let's say that I sell Pez dispensers, and all of a sudden, I don't know why I keep going back to this. I'm crazy. Let's say I sell Darth Vader Pez dispensers, and all of a sudden the demand for Pez dispensers goes through the roof. I can pretty quickly start producing a lot more Pez dispensers pretty fast. So the demand is going to go up, but the supply will go up too to meet the demand. So I've got what they call an elastic supply. And because my supply is elastic, prices aren't going to fluctuate like crazy. So now we've got 2 different kinds of real estate. On the left-hand side, we've got the Burj Dubai. On the right-hand side, we have a person's house. So one of these property types is very elastic, and the other one is not so elastic. Let's say we hit a great recession, and you are building an office building. It's going to take quite a lot for you to get to the completion of that office building. This development process could be a 10, heck, it could be a 15 or even 20-year process to get a big office building completed. And so that process is going to be operating outside of the world of what's going on in the local economy. And, this building in Dubai is a great example. I mean, we hit, the worst commercial real estate downturn, greater economic downturn than anybody has seen since the Depression. And because, this building was under construction, it still went and was built. So demand for office space in Dubai completely went away. There's no demand. People were not clamoring for office space. But because of the inelasticity of the development, the inelasticity of the supply, and adding more and more property to the inventory. So prices are just going to keep going down. On the other hand, you've got a house. You've got the residential market. You've got a residential developer who's building houses, and all of a sudden one day there's a huge bubble burst in residential real estate. You know what? It takes him a few weeks to finish whatever houses he's working on, and he can pretty much stop. He can just stop building houses. So that supply is really elastic. And because of that, because of the elasticity of that supply, that's why we see house values turning in such high correlation with the economy. But office space isn't nearly as elastic. Office space has these long development lags. I just pulled this off of a city's website. This is just a huge process just from the city's point of view. This doesn't include all of the things from the developer's point of view. And so there's this huge development period in order to develop commercial real estate. And the longer the development period, the more likely that the product's cycle isn't going to correlate with the greater economy. So what's the kind of property type that takes the longest to develop? Office space. Therefore, office values don't correlate very well at all to the greater economy, whereas residential has the shortest development cycle, especially after an area has been master planned and sold out to individual builders. Residential's got the shortest cycle, so residential is going to have that nice, neat cycle that's completely correlated to the economy. So if you've got more process, more red tape, things are less elastic, and the supply keeps on going long after the demand subsides. So we've answered that question. Different property types do move in different cycles. So the next question we had on our list was, are there differences across different geographies? And this is just from a paper that I pulled recently from the Journal of Real Estate Research, and this is just one example of hundreds. And I can answer that question in one simple slide. Are there differences across markets? Absolutely there are, yes. No doubt about it. On this market, you compare Denver with Boston, with Los Angeles, with San Francisco. Each market seems to have its own tempo of ups and downs, or big up and then big down, but they're all moving to the beat of their own separate drummer. So we answer that one pretty quickly. Different geographies have different economies, and those different metro economies are moving to their own different cycles. Therefore, you're going to have different cycles across different geographies. So we've answered most of our questions pretty quickly. We know that market cycles exist. We know that they're different across property types. We know that they're different across geographies. So the next question I had is, what's the value? So what? There are cycles. I mean, how can I use that in my day-to-day? Well, what is most valuable to me as a researcher is the fact that market cycles are a language, they're a tool that I can use to discuss commercial real estate. So I'm going to bring it back to that market cycle chart that we looked at earlier. I've got some very strict definitions around what it means to be in recession, what it means to be in recovery, what it means to be in contraction. And so what I can then do is go to each individual market, and if you see your market out on here, these aren't necessarily correct. I have not updated this slide since September of 2010. But what we can do is take each market, use those definitions, and categorize each market. And the value on that is that if you're an institutional owner of commercial real estate. You're an investor. You're somebody who's looking at a lot of markets all at once. You need a common language to talk about where those markets are. And the best way to do it is this common language of the market cycle. So you can quickly say, oh, okay, well, this market's in recession, so I know that I'm going to get more of a value for my dollar in this market. Whereas if a market's in number 9, which is that very peak of expansion, I know as a buyer that I can go into that market and expect not to get much value for my money, and I also know that I'm going to be competing with a lot of people to chase after the same real estate. So we work with a lot of clients who own a lot of commercial real estate in a lot of different markets, and they can't be experts in all the markets. So what we do is we just identify what markets they're in. We classify each market by what stage it is in the cycle, and we can quickly identify those areas. If you've got a portfolio and you've got a few buildings where the market's in recession, those are the markets where you might be able to go back and renegotiate a lease, for example. Those are the markets where you can go and invest and get more for your dollar. So the value for me as a researcher, the value of market cycles, and the value for brokers too, is it's a way for us, it's a common language to talk about commercial real estate. So that's how we communicate about differences in the markets. I thought I'd spend a few minutes talking a little bit now about what the future looks like. We've talked a little bit about market cycles, how they work, what the language is behind them. I thought I'd talk a little bit generally about what the economy was doing. So just to give you a little bit of language around what's going on both in the U.S. and the rest of the world. So in the U.S., we pretty much recovered, apparently, although it doesn't feel that way to a lot of people. So let me explain this chart. This is the percent of previous peak. So what does that mean? We remember that every gray bar in this chart represents a recession. So the black line represents how long it took for us to return to the peak of GDP after the recession ended. So, for example, right now, the peak was in 2007, and it took us until right now to return to 2007 levels of GDP. So that's kind of how we define recovery. We're back to the GDP that we were at before, and GDP means gross domestic product, which is just the total value of all the goods and services that are sold and bought in the United States. So if you're just looking at money volume, we've completely recovered. But that begs the question, why doesn't it really feel like a recovery? If we've really recovered, why doesn't it feel that way? So let's use that same methodology and see how long it's taken to recover employment. What a surprise. The GDP's recovered, but employment is still only at about 94.5% of what it was at the peak. So we've still got a lot of people who are now unemployed that weren't unemployed in 2007. So the U.S. has returned 100% GDP, but only 94% unemployment. So how can you have all the money but not have all the jobs? A report from Wells Fargo that came out recently highlighted it very succinctly. Production in the U.S. economy appears to be in the midst of a wholesale shift from labor-intensive industry toward capital-intensive industry. So what does that mean? You've got a shift from industries that require people, things like manufacturing, to industries that require capital, things like finance. We also saw an increase in worker productivity. So we're spending people who are buying our goods are spending the same amount of money as they were in 2007, but we're employing less people to create that same amount of goods. Plus we've had things like automation, and in the manufacturing world, this has been increasing for quite a long time. Robots are building things instead of people. Something else we're seeing in the retail world is retailer automation. It used to be kind of weird to go into the grocery store and check yourself out and not interact with another human being, but now I do it every day. That clerk, that checkout clerk, has been replaced by an automated checkout. It used to be part of my normal daily life to go to Blockbuster Video and rent a VHS tape, and now I go to Redbox and type into a computer screen, and it spits out a DVD. And you know what? I'm not even doing that much anymore. Mostly what I do is just get it on demand from Netflix on the internet. Digital distribution means that there's not even a real good being transacted. So you still got that sale, but you don't have any good being sold by a person or stored in a warehouse or manufactured. So all of that leads to this financial recovery of GDP, but we've still got this lag in employment. We're not back to the employment levels that we were at in 2007. So that's what that means for the economy. So then the question is, what does that mean for commercial real estate? I guess the short answer is it's too soon to tell. Another short answer might be it's not all bad, but it's not all good either. I think that in a lot of markets, financial center markets like New York, San Francisco, it's going to be good for the demand of office space. Obviously, in a lot of cases, it's going to be bad for retail, bad for places like Blockbuster Video, which is quickly becoming obsolete, bad for places like, Borders, which is having to close its locations, redefine others. It's bad for, if you've got lower manufacturing, there's going to be less manufacturing space needed. It could be good for warehouses. For example, you need space for all of those data warehouses. You got to store those ones and zeros somewhere. And there still is a lot of real things being bought and sold, and consumer purchases are on the upswing, so it still could be good for warehouse space. At the end of the day, what it really means ties right back into what we were talking about before. There's going to be even less correlation between the economy and commercial real estate. That sweet up and down that we saw in single-family residential, we're just not going to see that as much in commercial real estate. We're just not going to see something directly tied to changes in the economy. And what that means is, until we can learn to create a model to be based around these new realities, we really don't know what the future holds exactly. The more we learn about the new economy, the less we know. So anyway, on that happy note, we subscribe to IHS Global Insight, and we pay a pretty penny for their predictions, their forecasts. So because we pay money for it, I always use it in every presentation. I try to use it in every presentation I give. So here from IHS Global Insight is their current forecast for the U.S. Market indicators. They're saying we're going to see 3% annual growth through, about 3% annual GDP growth through 2014. As we've learned, that doesn't necessarily mean a similar growth in employment. So the unemployment rate through 2014, we're expecting to drop down to 7%. That's good. I don't think that's as low as it was in 2007, but that's better than 9.6%, for example. So what about the rest of the world? I know that there were a few people signed up on this call who are not based in the United States. Colliers International is not only based in the United States, so let's see where else we're at. This is from The Economist. The economist for the United States is also predicting a little bit more optimistic. They're saying for next year 3.2% GDP growth. Japan, we can guarantee that Japan will not be 2%, even though that's what the economist is predicting here. We don't know what the heck is going to be in Japan. Japan has had an event which we're really not sure what the reverberations are going to be across Asia or the rest of the world. China is, the economist is predicting an 8.7% growth for China, which is lower than we saw in 2011, and that's not because it couldn't be higher. It could, but China is trying to pull in the reins a little bit on their out-of-control GDP growth. And because their government also completely controls their economy, it's a lot easier for them to do things like that. So China's pulling in the reins, but they've still got spectacular growth percentages as compared with most of the rest of the world. You look at the euro area, you've got really anemic growth, which is going to continue through the next year. I know, for example, in Portugal, we're now expecting that that's another country that's going to have to be bailed out by others in the euro area. Germany, I guess, I don't know. Somebody's going to have to be bailing out Portugal. I know their prime minister just resigned, and they're in major trouble. So that part of the world not doing so well. Question marks all over the place. Hey, let's look at Egypt. Who knows what's going to happen in Egypt? I know their stock market opened yesterday, and I think it dropped by 9 percentage points. I think it dropped a percentage point a minute in the first 9 minutes that it was open. So who knows what the heck's going to happen in Egypt. Their economy's, to a certain extent, controlled by their military, which is still in power. So you may see that predicted growth of 4.3%, but that could be something else too. Who knows? Latin America, we're seeing very strong growth in places like Argentina, which we're expecting 10% growth in GDP next year. Lots of strength in most Latin American countries, with the exception of Venezuela. Only 2% predicted in Venezuela. So here's what we're interested in, commercial real estate. We've got I'll make a plug here, we've got a new global office report that's coming out either later this week or early next week. It's been written, it's been proofread. We're just waiting for the graphic designer to put the finishing touches on it. But this is information that I pulled out of that, and we've just tried to get a big picture around what global vacancy rates look like right now. In the EMEA and the Asia Pacific, they're both about at 12% office vacancy rates, and they've been stably at that level for a little bit. Latin America, stable also, stably at 6% for quite a while. In the U.S., we're up there. Usually high numbers are good, not so much with vacancy rate. We're up there at 16%. But as you can see, it looks like we've peaked at vacancy rate on the U.S., and we're in a downward trend. So all in all, things could be better, but things have been worse, and they've actually been worse in a lot of places in their recent history. So we can expect slow, anemic growth in the greater economy, and as we've learned, that may or may not translate into growth in real estate values. Some values in real estate may respond very nicely to the economy. For example, if we see a nice upturn in employment, we're going to see a nice upturn in residential sales and residential values. But in property types like office, where you've got those longer development cycles, they're not going to highly correlate with the economy. Things are a little bit more complicated. Well, hey, I've run out of things to say, and I've taken up 43 minutes of your time, so I thought I'd open it up to questions. Well, that's my contact information right there. Shoot me an email. I'll send you the copy of the slide deck if you're interested. I'm a huge fan of talking about the economy and how it relates to commercial real estate. So if you want to start a discussion with me, I'm happy to do it.